Before we dive in, a quick and very important disclaimer. I am not a licensed financial advisor, and the contents of this video are for educational and entertainment purposes only. This presentation is not financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Please consult with a qualified professional before making any financial decisions. Your financial situation is unique, and any action you take based on the information in this video is strictly at your own risk. Alright, let's get into it. There's a number you've probably heard, but maybe never really thought about. 10%. For the last century, through world wars, crippling recessions, tech booms, and global pandemics, the US stock market, on average, has returned about 10% per year. Now, that doesn't mean it goes up 10% every single year like clockwork. Some years are incredible. Some years are brutal. But over the long run, that 10% average has been one of the most powerful wealth-building machines in human history. So why does it feel like a secret club you're not invited to? Why does turning on a financial news channel feel like trying to decipher a foreign language, with all the talk of bulls and bears, PE ratios, and quantitative easing? You see the scrolling numbers, the red and green arrows, and it all just looks like a high-stakes casino where you're guaranteed to lose your money to some Wall Street shark in a $1,000 suit. You're not alone in feeling that way. Millions of Americans are sitting on the sidelines, keeping their hard-earned money in savings accounts where it's actually losing value to inflation every single day. They're held back by a few simple, fundamental questions. Questions they feel are too basic, maybe even too dumb to ask. But they aren't dumb. They are the most important questions you can ask. And today we're going to answer them. We're going to rip away the jargon, tear down the complexity, and give you the 5 most critical answers you need to understand what the stock market is, how it works, and how you can be a part of it. This isn't about get-rich-quick schemes or risky day trading. This is about giving you the foundational confidence to start your journey toward building real, long-term wealth. We're going to tackle the big 5. First, what is the stock market, really? Forget the squiggly lines on the screen. What are you actually buying? Second, is it just gambling? We'll confront the biggest fear head-on, the fear of losing everything. Third, how much money do you actually need to start? The answer is going to shock you. Fourth, what's the difference between a stock, an ETF, and a mutual fund? We'll finally make sense of that alphabet soup. And finally, number 5, okay, I get it. But how do I actually buy my first stock? We'll walk through the practical steps. By the end of this video, the confusion will be gone. You will have more clarity than 99% of people out there, and you'll be ready to take control of your financial future. So let's start with the biggest question of all. Question number 1. What even is the stock market? The simplest way to think about it is this. The stock market is a giant supermarket of companies. Imagine you could walk into a massive store, and on the shelves you see all the brands you know and love. Apple is on one shelf. Nike is on another. Starbucks, Amazon, Coca-Cola, Ford, they're all there. Now, instead of buying a product from them like an iPhone or a cup of coffee, you can buy a tiny microscopic piece of them. That tiny piece is called a share of stock. When you buy 1 share of Apple stock, you are not just buying a number on a screen. You are becoming a part owner of the Apple Corporation. You own a sliver of every iPhone patent, a fraction of every Apple store, a piece of the desk Tim Cook sits at. If Apple does well, makes a ton of profit, and grows bigger, the value of your tiny piece goes up. If it does poorly, the value of your piece can go down. That's it. That's the core concept. You're not betting on a random number. You are investing in a real-life business that makes things and sells them to people. So where does this buying and selling happen? In the United States, there are 2 main supermarkets or stock exchanges. The first is the New York Stock Exchange, the famous NYSE. This is the old-school, iconic one you see in movies with the big trading floor. It's home to many of America's oldest and most established blue-chip companies, like Johnson & Johnson and the Home Depot. The other major exchange is the NASDAQ. This one is all electronic and is famous for being the home of technology giants like Microsoft, Google, and Amazon. Think of them as 2 competing grocery chains like Kroger and Safeway. They both sell groceries, or in this case, shares of companies. They just operate a little differently. But why would a company like Apple or Starbucks want to sell off tiny pieces of itself to millions of strangers like you and me? The answer is simple: to raise money. Let's say you own a fantastic local coffee shop. It's so popular, the line is always out the door. You want to expand and open 10 more locations, but that costs millions of dollars you don't have. So you decide to take your company public. You do what's called an initial public offering, or IPO. You divide the ownership of your entire coffee business into, say, 1 million little pieces or shares, and you sell them on a stock exchange. Investors who believe in your coffee shop buy those shares. Suddenly, you have the millions of dollars you need to build those new stores, hire more people, and create a new line of artisanal coffee beans. You get the cash to grow, and your investors get to be part owners who share in the future success of your company. That's the engine of capitalism right there. It's how great ideas get the funding they need to become global powerhouses. Now for the part that scares everyone. Why do the prices go up and down so much? A stock's price is simply what a buyer is willing to pay for it, and what a seller is willing to sell it for at any given moment. It's a massive real-time auction with millions of participants. The price changes based on two main things: the company's actual performance and people's feelings about its future performance. If Apple announces a revolutionary new product and reports record-breaking profits, more people will want to buy a piece of that success. High demand with a limited supply of shares pushes the price up. Conversely, if a car company has to recall millions of vehicles and its CEO gets into a scandal, investors might get scared. They'll rush to sell their shares, fearing the company will lose money. High supply and low demand pushes the price down. It's a constant tug-of-war between optimism, which we call a bull market, and pessimism, a bear market. It's driven by news, by economic data, by competition, and by human emotion. But how do you keep track of all this? You can't possibly follow the thousands of companies on the market. That's where stock indexes come in. You've definitely heard of them. The Dow Jones Industrial Average and the S&P 500. An index is just a report card for a section of the market. It's a shortcut. Instead of checking the price of every single company, you can just look at the index to get a quick snapshot of how things are going overall. The Dow Jones is the oldest and most famous, but it only tracks 30 very large, well-known U.S. companies. It's like judging the health of the entire U.S. population by only looking at 30 Olympic athletes. It's useful, but not the whole picture. The much more important index for most investors is the S&P 500. The S&P 500 tracks the 500 largest and most influential public companies in the United States. It represents about 80% of the entire U.S. stock market's value. It includes companies from every sector: tech, healthcare, finance, consumer goods, you name it. So when you hear a news anchor say, "The market was up today," they usually mean the S&P 500 went up. It's the single best indicator of the health of corporate America. If the S&P 500 is consistently trending upwards over time, it means that, on average, the 500 biggest businesses in the country are growing, innovating, and making more money. And by investing in something that tracks this index, which we'll talk about later, you get to grow with them. So to recap question number 1, the stock market isn't a casino. It's a mechanism for you to become a part owner in the world's most successful and innovative businesses. You buy a share, which is a tiny piece of a real company. Those companies sell shares to raise money to grow. And the prices go up or down based on their performance and investor confidence, all tracked by indexes like the S&P 500, which give us a snapshot of the economy's health. Understanding this one concept is the first giant leap away from fear and toward financial empowerment. But it immediately leads to the next, even more critical question. What actually makes a stock's price go up or down? Seems like magic. One day a stock is worth $100, the next it's $110, and the week after it's $95. It feels random, like a roll of the dice in a casino. But it's not. There's a powerful, predictable logic behind it all, and to understand it, let's leave Wall Street behind for a minute and go to Main Street. Imagine there's a local coffee shop in your town called The Daily Grind. It's incredible. The coffee is amazing, the service is friendly, and there's a line out the door every single morning. The owner, let's call her Jessica, has a brilliant business. She's making good money, but she has a bigger dream. She wants to open 5 more locations across the state. The problem is that takes a lot of cash she doesn't have. So Jessica decides to go public. This is the moment a private company first offers its shares on the stock market. She's not just asking for a loan. She's selling tiny individual pieces of ownership in the Daily Grind. Each piece is a share. Her investment bankers help her figure out what the company is worth. They look at her profits, her equipment, her brand reputation, and her plan for the future. They decide to issue 1 million shares, and they set the initial price at $10 per share. This means on day 1 anyone, you, me, your neighbor, can buy a piece of the Daily Grind for $10. Now the clock starts. The stock is officially trading on the market. And this is where the magic happens. the price of that $10 share will almost never stay at $10. It will start to move based on one of the oldest, most powerful forces in human economics: supply and demand. Let's play this out. Scenario 1: the price goes up. A month after going public, a famous food blogger posts a video about the Daily Grind's signature latte. The video goes viral. Suddenly, everyone in the country has heard of this amazing coffee shop. Sales at the original location skyrocket. Jessica announces that her plans to expand are moving ahead of schedule. What happens in the stock market? People see this good news. They think, wow, the Daily Grind is going to be huge. Their profits are going to explode. I want to own a piece of that success. Suddenly, thousands of people want to buy shares of the Daily Grind. But there are only 1 million shares in existence. You have way more buyers than you have sellers. It becomes an auction. Someone who owns a share for $10 might think, well, I'll sell, but with all this excitement, I'm not selling for 10. I want 11. A buyer, desperate to get in on the action, agrees. Boom. The stock price is now $11. Another buyer sees this and says, I'll pay 12. And just like that, the price climbs. High demand and limited supply force the price upward. The company is doing well, people are optimistic, and the stock price reflects that optimism. Now let's look at the opposite. Scenario 2. The price goes down. 6 months later, a massive global coffee chain, let's call them Planet Coffee, opens a brand new super modern store right across the street from the Daily Grind. They sell coffee for half the price. At the same time, a news report reveals that the price of coffee beans is expected to double in the next year due to a bad harvest. What happens now? The story changes. Investors start to worry. Oh no, they think. The Daily Grind is going to lose customers to Planet Coffee, and their costs are about to go up. Their profits are going to get crushed. The people who own shares get nervous. They start to think, I should sell my shares now before the price drops even more. Suddenly, you have thousands of people trying to sell their shares, but very few people want to buy them. Again, it's an auction, but this time in reverse. A seller who bought at $12 might say, okay, I'll sell for 11. No takers. Fine, what about 10? Still no buyers. A nervous seller finally panics and says, I'll just take $9. I just want to get out. Someone who thinks the fear is overblown might finally agree to buy at that price. Boom. The stock price is now $9. More sellers than buyers creates a downward pressure on the price. The company is facing challenges, people are pessimistic, and the stock price reflects that pessimism. This simple push and pull of supply and demand, driven by news and performance, is the absolute core of why stock prices move. But it gets deeper. It isn't just one news story. The price of a stock is actually reacting to a constant storm of information, which we can group into 4 main categories. First, there's company performance. This is the most obvious one. Just like we saw with the Daily Grind, the price is directly tied to how well the business is actually doing. Every 3 months, public companies are required to release an earnings report. Think of it as the company's report card for the quarter. It tells everyone, here's how much we sold, here's how much it cost us, and here's how much we profited. If a company posts surprisingly high profits, the stock usually goes up. If they announce they lost money, the stock almost always goes down. Second, there are industry trends. A company doesn't exist in a vacuum. What if a new scientific study proves that drinking 5 cups of coffee a day extends your life by 10 years? That's great news for the Daily Grind. But it's also great for Planet Coffee and every other coffee company. The entire industry gets a boost, and their stock prices might all rise together. Conversely, if a new trend emerges where people stop drinking coffee and start drinking energy drinks, the whole coffee industry could suffer, dragging the Daily Grind stock down with it, even if Jessica is doing everything right. Third, you have the overall economy. This is the big picture stuff. Is the country in a recession? Are a lot of people unemployed? If so, they have less money to spend on things like $10 lattes. So, even if the Daily Grind is a fantastic company, their sales might dip simply because their customers are cutting back. Interest rates set by the Federal Reserve are another huge factor. When interest rates are high, it's more expensive for companies to borrow money to expand, which can slow down their growth and hurt their stock price. When rates are low, it's cheap to borrow and grow, which is great for stocks. And that brings us to the fourth and perhaps most unpredictable driver: human emotion. The stock market is not a perfect, cold, calculating machine. It is a collection of millions of human beings making decisions. And humans are driven by two very powerful emotions: greed and fear. Greed is what creates hype. A stock can become a viral sensation. People see it going up and they experience FOMO, the fear of missing out. They pile in, buying the stock not because they studied the company's earnings report, but simply because they see the price rising and they want a piece of the action. This can push a stock's price far beyond what the company is actually worth. But fear is even more powerful. A scary rumor, a negative news headline, or a sudden market downturn can cause panic. People start selling indiscriminately, not because anything has fundamentally changed with the business, but because they're afraid of losing money. This fear can feed on itself, causing a stock to crash, sometimes in a matter of hours. So when you see a stock price flickering on the screen, remember it's not a random number. It is the real-time result of this massive global conversation. It's the sum of a company's performance, the health of its industry, the state of the economy, and the collective hopes and fears of millions of investors, all distilled into a single number that represents its current price. Understanding this dynamic is the key. It transforms the market from a casino into a living, breathing ecosystem. It's complex, yes, but it's not unknowable. But it does raise a very important question. If prices can swing wildly based on news, rumors, and emotion, isn't this just a sophisticated form of gambling? How is investing any different from betting it all on red? That is the million-dollar question, isn't it? The line between investing and gambling can feel incredibly blurry, especially when you see headlines screaming about someone turning $1,000 into $1 million on some obscure crypto coin or a forgotten video game retailer. Your cousin's friend's brother made a killing on a meme stock, and suddenly, everyone with a smartphone thinks they're the next Warren Buffett. It feels like a casino, a massive digital Las Vegas where the stakes are your life savings. And if that's true, why would any sane person participate? The truth is, the stock market can be a casino. You can absolutely treat it like one. You can bet on short-term price movements, use complex derivatives you don't understand, and chase hot tips you found in an anonymous online forum. If you do that, you are, for all intents and purposes, gambling. You're pulling the lever on a slot machine and hoping for the best. And just like a casino, the odds are methodically, mathematically stacked against you. But that's not what investing is. The fundamental difference between investing and gambling comes down to one powerful concept: ownership. When you go to a casino and put $100 on black at the roulette table, what do you own? Nothing. You have a claim on a potential outcome. The ball will land, and in an instant, your money will either double or vanish. It's a binary, short-term event. You haven't created any value. You've simply bet on a random number generator. Now, imagine instead you take that same $100 and buy a single share of, say, Apple. What do you own now? You own a tiny fractional piece of one of the largest, most profitable companies in human history. You own a sliver of the patent for the iPhone. You own a microscopic part of every MacBook, every Apple Watch, every transaction on the App Store. You are entitled to a tiny fraction of their profits. You're not just betting on a number. You are a part owner of a global value-producing enterprise. This is the chasm that separates the investor from the gambler. The gambler bets on a price. The investor partners with a business. Let's make this more concrete. Imagine two people, Dave and Sarah. Both have $5,000 to put to work. Dave hears a rumor online about a biotech startup, NanoHeal, that's supposedly on the verge of a breakthrough cancer cure. The stock is trading for pennies. He sees dollar signs. He dumps all $5,000 into it. He doesn't read their financial reports. They're losing money, but who cares? He doesn't know who the CEO is. He just knows the story and the hype. He checks the stock price 20 times a day. His heart pounds with every tick up, and his stomach drops with every tick down. He's riding an emotional roller coaster, completely at the mercy of market whims and press releases. Dave is gambling. Sarah, on the other hand, takes her $5,000 and thinks about the world around her. She sees people everywhere drinking coffee. She researches Starbucks. She looks at their history of growth, their global brand recognition, their plans for expansion. She sees they consistently make a profit, and even pay a portion of those profits back to shareholders as a dividend. She understands their business. It's not as explosive or exciting as a penny stock, but it's real. She buys $5,000 worth of Starbucks stock. She doesn't check the price every day. She knows that the value of her ownership isn't determined by one day's news cycle, but by the company's ability to sell millions of cups of coffee, year after year. Sarah is investing. The second key difference is time. Gambling is an event. Investing is a process. In a casino, the longer you play, the more certain it is that the house will win. Time is your enemy. In investing, time is your greatest ally. It's the magic ingredient. That tiny piece of a real productive business you own has time to grow, to innovate, to sell more products, to generate more profit. And as it does, the value of your ownership stake grows with it. The S&P 500, that basket of the 500 largest U.S. companies, has had down years, even terrifying crashes. But over any 20-year period in its history, it has never lost money. Time smooths out the terrifying volatility and allows the fundamental engine of economic growth to do its work. The gambler is looking to score tonight. The investor is looking to build a cathedral over decades. Finally, think about the game itself. Gambling is a zero-sum, or more accurately, a negative-sum game. For you to win $100 at the poker table, someone else has to lose that $100. And in the end, the casino takes its cut, so the players as a whole walk away with less money than they started with. The pie shrinks. Investing, on the other hand, is a positive-sum game. When you invest in a great company, you aren't taking money from someone else. You are participating in value creation. The company uses capital from you and other investors to build a new factory, develop a new life-saving drug, or create software that changes the world. They hire people, generate profits, and grow the entire economic pie. Everyone can win. Your success doesn't require another investor's failure. You are both lifted by the rising tide of human ingenuity and economic progress. So, is the stock market just gambling? No. It's a venue. It's a tool. And that tool can be used with the mindset of a gambler or the mindset of an investor. Your behavior, not the market itself, determines which game you're playing. Are you buying something you don't understand based on a hot tip? You're gambling. Are you day trading, trying to predict minute-to-minute swings? You're probably gambling. Are you buying ownership stakes in well-run, profitable businesses that you understand, with the intention of holding them for years to allow them to grow? That is investing. It's the difference between betting on a single hand of cards and owning a piece of the entire casino. One is a game of chance. The other is a business venture. The casino is designed to take your money over time. The economy, which the stock market represents, is designed to grow over time. As an investor, you get to put your money on the side of that long-term wealth-creating growth. You're not betting against the house. You are the house. Now, accepting this distinction is the first major hurdle. It shifts your entire perspective from, how can I get rich quick, to, how can I participate in long-term growth? But once you make that shift, a new, very practical question immediately comes to mind. Okay, I'm not a gambler, I'm an investor. But how do I even get started? Don't you need to be rich to invest? Do I need thousands of dollars just to open an account and buy a single share of some of these giant companies? The short answer? Absolutely not. Not anymore. That idea, the one that says you need a fat bankroll and a tailored suit just to get in the game, is one of the biggest, most persistent, and most damaging myths in all of finance. It's a relic of a bygone era, and today, it's holding millions of people back from building real wealth. Let's rewind the clock for a second, just to understand where this idea came from. 20-30 years ago, it was largely true. Investing was an exclusive club. If you wanted to buy a stock, you couldn't just whip out your phone. You had to call a guy, a stockbroker, in a stuffy office downtown. This broker was the gatekeeper. And gatekeepers charge a toll. Every single time you wanted to buy or sell, you paid a hefty commission, maybe $50, $75, even $100 per trade. So, if you only had $100 to invest, you could lose it all to fees before you even owned a single share. It simply didn't make sense for the little guy. The system was designed for people who could invest thousands, tens of thousands of dollars at a time, where those commissions were just a small percentage of the total. On top of that, you had to buy whole shares. If a stock was trading at $500 per share, you needed $500 plus the commission just to buy one. It was a high barrier to entry, and it kept ordinary people on the sidelines, with their money sitting in savings accounts getting eaten alive by inflation. But then something happened that changed everything. The internet. And with it, the smartphone. This wasn't just a technological revolution, it was a financial democratization. Suddenly, the gatekeepers were gone. In their place rose a new breed of companies. Online discount brokerages. You know the names. Fidelity, Charles Schwab, Vanguard, and the newer app-based platforms like Robinhood and Webull. The first thing they did was slash commissions. The $50 fee became $10, then $5, and now, for most standard stock trades on major platforms, it's $0. Free. That, in itself, was a game changer. It meant you could invest $100 and have all $100 actually go to work for you. But that still didn't solve the other problem. What if you want to invest in a powerhouse company, a giant like Amazon or Google or Nvidia, but a single share costs hundreds or even over $1,000? This is where the second and arguably more important innovation comes in. It's called fractional shares. And it is the single greatest tool for the new investor ever created. Think of it like this. Imagine your favorite company, let's say it's Tesla, is a giant, delicious, expensive pizza. In the old days, if you wanted a piece of that pizza, you had to buy the whole pie. If the pizza cost $1,000, you needed $1,000. No exceptions. Most of us can't just drop $1,000 on a pizza, so we just had to stand there and smell it, unable to get a taste. Fractional shares changed the rules. The brokerage effectively takes that giant $1,000 pizza and says, "We're going to slice this up into 100 tiny slices. Now each slice costs just $10. You don't have to buy the whole pie anymore. You can walk up with the $10 bill in your pocket and buy one slice. You are now a part owner of that pizza. You own a fraction of it. You have the same exposure to its success or failure as the person who bought the whole thing, just on a smaller scale. If the value of the whole pizza doubles, the value of your $10 slice also doubles. This is not a simulation. This is real ownership. If you have $50, you can buy $50 worth of Amazon. If you have $20, you can buy $20 worth of Apple. If you have one single dollar, you can buy $1 worth of the S&P 500 through an ETF. You can literally start investing with the spare change you find in your couch cushions. The psychological shift this creates is monumental. It transforms investing from a distant, unattainable goal. I'll invest when I save up $10,000 into an immediate, accessible action. I have $25 left in my budget this week. I'm going to put it to work right now. And this leads to the most powerful force in all of finance: consistency. Let's imagine two people, Sarah and Tom. Tom is a perfectionist. He believes in the old myth. He wants to wait until he has a big lump sum, say $5,000, before he starts investing. He thinks that's the right way to do it. So he spends 2 years diligently saving up. Sarah, on the other hand, hears about fractional shares. She decides to start small. She sets up an automatic transfer of just $50 a week. That's about $7 a day, the cost of a fancy coffee, into her investment account. Doesn't feel like much. Some weeks she can barely notice it's gone. After 2 years, Tom finally has his $5,000. He's proud. He invests it all in one go. In that same time, Sarah has been investing her $50 a week every week without fail. She's invested a total of $5,200. But here's the magic. Her account isn't worth $5,200. Because her money has been in the market working for her for 2 full years, it's had time to grow. It's had time to earn dividends, and for those dividends to be reinvested. It's had time to compound. Depending on the market, her account could be worth $6,000, maybe even $7,000 or more. She's already ahead of Tom, not because she invested more money, but because she invested her money sooner. She bought shares when the market was up, and she bought them when the market was down, averaging out her cost over time. She harnessed the power of time, which is an investor's single greatest asset. An asset that no billionaire can ever buy more of. This is the new reality of investing. It's not about how much you start with. It's about that you start. It's about building a habit. The minimum deposit on most major brokerage accounts today is $0. You can link your bank account and transfer $5 and be an owner of the world's greatest companies in less time than it takes to order a pizza. The gates have been smashed open. The walls have come down. The question is no longer, can I afford to invest? The real question now is, can I afford not to? So okay, the money barrier is gone. I don't need to be a millionaire. I can start with the $10 in my pocket right now. But that just blows the door open to a whole new terrifying room full of questions. With thousands and thousands of companies out there, with all these tickers and charts and complicated looking graphs, where on earth do I even begin to put my money? How do I pick a winner instead of accidentally betting on the next blockbuster video? That is the million-dollar question. Literally. And the honest answer is, there is no single magic bullet answer. If there were, we'd all be billionaires sipping iced tea on a private island. But what I can do is break down the two main philosophies, the two great schools of thought when it comes to picking where your money goes. And once you understand them, you'll have a framework to decide which path is right for you. Think of it like this: you want to travel from New York to Los Angeles. One way is to buy a beat-up 1970s station wagon. a bunch of maps, and set off on a grand adventure. You'll be in total control. You can take detours, find hidden gems, maybe even get there faster if you find a secret shortcut. But you could also break down in the middle of nowhere, get hopelessly lost, or spend way more time and money than you planned. That's active investing. The other way is to buy a plane ticket. You hand over control to the pilot in the airline. It's a proven, reliable system. You won't discover a charming small town along the way, but you are almost guaranteed to arrive at your destination safely and on schedule. That's passive investing. Let's start with the road trip. Active investing. This is the one you see in the movies. This is the world of Warren Buffett, of Peter Lynch, of eagle-eyed investors poring over financial reports late into the night, looking for that one undervalued company, the diamond in the rough, that the rest of the market has overlooked. The goal of the active investor is to beat the market. They aren't content with just getting the average return. They want to be exceptional. How do they do it? They become detectives. They practice something called fundamental analysis. This means they're not just looking at a stock's price. They're investigating the entire business behind the ticker symbol. They read annual reports, which are like a company's report card. They analyze the balance sheet to see how much debt the company has. They study the income statement to see if profits are growing. They ask the big questions. Does this company have a durable competitive advantage, something Wall Street calls a moat? Is it like a castle with a wide moat and crocodiles, making it hard for competitors to attack? Think of Coca-Cola's brand name, or Google's dominance in search. They also look at the leadership. Is the CEO a visionary or just a caretaker? They study the industry. Is this a growing field like cloud computing, or a shrinking one like print newspapers? They try to calculate a company's intrinsic value, what it's really worth, and then see if the market is selling it for a discount. It's like finding a brand new iPhone at a garage sale for $50. You know it's worth more, so you buy it. The allure is undeniable. The idea of using your own intellect to find the next Amazon or Apple before anyone else is incredibly powerful. It can be a fascinating, intellectually stimulating hobby, but, and this is a massive but, it is incredibly difficult. It takes a huge amount of time, a ton of research, and an almost unshakable emotional discipline. Because when a stock you pick drops 30%, your gut will scream at you to sell. The active investor has to have the conviction based on their research to hold on or even buy more. And here's the cold, hard truth that most Wall Street firms don't want you to hear. The vast majority of active investors, including the highly paid professionals managing multi-billion-dollar funds, fail to beat the market over the long term. Study after study confirms this. They take that cross-country road trip, but after all the breakdowns, wrong turns, and hotel costs, they find they would have been better off just buying the plane ticket. They end up underperforming the very market they were trying to beat. Which brings us to the plane ticket. Passive investing. This philosophy was pioneered by a man named John Bogle, the founder of Vanguard. He was a true revolutionary. He looked at the data and saw that all these professional stock pickers were charging their clients high fees for performance they rarely delivered. He had a simple, brilliant idea. What if, instead of trying to beat the market, you just bought the whole market? This is the core of passive investing. Instead of trying to find the needle in the haystack, you buy the entire haystack. How? Through something called an index fund. An index is just a list of stocks that represents a slice of the market. The most famous one is the S&P 500. It's a list of 500 of the largest, most established companies in the United States. Think Apple, Microsoft, Amazon, Johnson & Johnson, Visa. These are the titans of the American economy. An S&P 500 index fund is a single fund that holds stock in all 500 of those companies. So, when you buy one share of an S&P 500 index fund, you instantly become a part owner of 500 different businesses. You own a tiny slice of the iPhone's success, a sliver of every Windows computer sold, a piece of every package Amazon delivers. The beauty of this is its simplicity and its built-in diversification. Remember the fear of picking the next blockbuster video? With an index fund, that fear largely disappears. Sure, some of those 500 companies will fail over time. Enron was in the S&P 500, so was Lehman Brothers. But others will rise to take their place. For every blockbuster, there's a Netflix that comes along. By owning the whole market, you guarantee that you will own the winners, and their massive growth will far outweigh the losses from the companies that fail. You're no longer betting on your ability to be a brilliant detective. You're making a single broad bet on the long-term growth and innovation of the American economy as a whole. And historically, that has been one of the safest and most profitable bets you can make. The goal isn't to beat the market. The goal is to be the market. You accept the average market return, which, by the way, has historically been around 10% per year over the long run. And because you're not paying a team of expensive analysts to pick stocks, the fees for index funds are incredibly low, meaning more of your money stays in your pocket working for you. So, which one is right for you? The adventurous road trip or the reliable flight? For most people, for the vast majority of people who have busy lives and careers and don't want to spend their evenings reading SEC filings, passive index fund investing is the undisputed champion. It's the strategy recommended by legendary investors like Warren Buffett for their own family's money. It's a disciplined, low-cost, and statistically proven way to build serious wealth over time. But what if you have that itch? What if you love business and you're fascinated by the challenge of finding that next great company? Does that mean you have to go all in on the risky road trip? Not at all. Many people adopt a hybrid approach. They put the core of their portfolio, say 80 or 90%, into low-cost, diversified index funds. This is their serious money, their retirement nest egg, their plane ticket to their financial destination. Then, with the remaining 10 or 20%, they allow themselves to take that road trip. This is their play money. They use it to buy individual stocks in companies they believe in. If they're right, they get the thrill of victory and some extra profit. If they're wrong and their pick goes to zero, it's a lesson learned, but it doesn't derail their entire financial future. Their core portfolio, the plane, is still flying safely towards its destination. This approach gives you the best of both worlds: the reliable, long-term growth of passive investing, and the intellectual stimulation and potential upside of active investing, all while managing your risk. It turns stock picking from a high-stakes gamble into an engaging educational hobby. So when you ask, how do I pick a stock? The first answer you need to find is what kind of investor you want to be. Do you want to be the pilot? Or do you want to be the passenger? There's no wrong answer, but understanding the difference between the two is the first giant leap toward investing with confidence. It's the key that unlocks the rest of the puzzle. Now, once you've decided on your strategy, a new question immediately pops up. What stocks should I buy? This is it. This is the question that fuels a billion-dollar industry of talking heads, gurus, and flashy newsletters. Everyone wants the hot tip, the secret code, the name of the company that's about to triple overnight. And I have to be brutally honest with you. If anyone on the internet ever gives you a specific stock pick and tells you to buy it, you should run in the other direction. Fast. Not only is it often illegal for them to do so, but it's also fundamentally useless. Giving you a stock pick is like giving you a fish. It might feed you for a day, but it teaches you nothing. My goal is to teach you how to fish. Because the real answer to what should I buy isn't a company name. It's a strategy. And there are two main paths you can go down. The first path is the simplest, the most time-tested, and for over 90% of people, probably the most effective. It's the path of not picking individual stocks at all. Now that might sound crazy. Isn't the whole point of the stock market to pick stocks? Not necessarily. Think of the stock market, specifically an index like the S&P 500, as a giant supermarket. The S&P 500 is just a list of the 500 largest, most influential public companies in the United States. It's the produce section of our supermarket. Now, you could spend hours and hours in that produce section. You could inspect every single apple. You could check for bruises, test for firmness, try to figure out which specific apple is the most perfect, most delicious apple in the entire store. Maybe you find it. Maybe you don't. Maybe the one you thought was perfect has a worm in it. You just don't know. That's stock picking. Or, you could just buy a basket that contains a small slice of every single piece of produce in the entire section. This is called an index fund or an ETF. Instead of betting on one single company, one single apple, you're buying a tiny piece of all 500 of them. You're buying the whole market. You'll own a piece of Apple and Microsoft and Amazon and Johnson & Johnson and every other major player. Some of those companies will have a fantastic year. Some will have a terrible year. But by owning all of them, you smooth out the bumps. You get the average return of the entire market. And historically, the average return of the S&P 500 has been about 10% per year over the long run. Now you might think, only 10%? I want to do better than average. And that's the siren song that lures so many people into trouble. Let me tell you a quick story about the most famous investor in the world, Warren Buffett. Back in 2007, Buffett made a public $1 million bet. He wagered that a simple low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over a period of 10 years. Now remember, hedge funds are the so-called smart money. They are run by geniuses from Harvard and Yale. They use complex algorithms, they have access to incredible research, and they charge exorbitant fees for their expertise. They are the professional apple pickers. Who do you think won? It wasn't even close. Over the 10-year period, the simple, boring S&P 500 index fund returned over 7% per year. The sophisticated hedge funds? They averaged just over 2% per year. Buffett won the bet in a landslide, and he donated the winnings to charity. The lesson is profound. Trying to beat the market is incredibly difficult. Even the highest-paid professionals on Wall Street fail to do it consistently. So, for most people, the smartest move is to not even try. Just buy the whole market through a low-cost index fund, keep adding to it over time, and let the power of the American economy do the heavy lifting for you. But what if you're not most people? What if you hear that story and think, yeah, but I want to be the exception. I want to find the next Amazon. That brings us to the second path. Picking your own individual stocks. This path is harder. It requires more work, more research, and more emotional discipline. But the potential rewards can be much, much higher. If you're going to walk this path, you can't treat it like a casino. You have to treat it like you're becoming a part owner in a business. Because that's exactly what you're doing. So, how do you find a good business to own? There are 4 key things to look for. First, you have to understand the business. The legendary investor Peter Lynch had a famous rule: buy what you know. He didn't mean you should just buy stock in your favorite coffee shop because you like their lattes. He meant you should invest in businesses that you can fundamentally understand. Can you explain what this company does and how it makes money to a 10-year-old in 60 seconds? If the answer is no, you should not invest in it. Period. It doesn't matter if it's a hot biotech company with a complicated drug patent or a fintech firm with a confusing blockchain algorithm. If you don't get it, you can't properly evaluate it. Second, the company needs a moat. This is another term from Warren Buffett. He thinks of great businesses as castles, and the best castles have a wide, deep moat around them to protect them from invaders. In business, a moat is a durable competitive advantage. It's something that protects the company from its competition. What does that look like? Could be a powerful brand like Coca-Cola. People will pay more for a Coke, even though the generic store brand tastes almost identical. Could be a network effect like with Meta's Facebook or Instagram. The more people that use it, the more valuable it becomes for everyone, making it almost impossible for a new competitor to break in. Could be high switching costs like with Apple. Once you have an iPhone, an Apple Watch, a MacBook, and all your photos are in the iCloud, the thought of switching to Android is a massive, expensive headache. Or it could be a low-cost advantage like Walmart or Amazon, who can sell products cheaper than anyone else because of their incredible scale. A company without a moat is a sitting duck. Third, you need to check its financial health. You don't need to be a certified accountant, but you do need to be a doctor making a basic diagnosis. Is the patient healthy? You can find a company's financial statements for free online. Look at the basics. Is its revenue, the total amount of money it brings in, going up year after year? That's a good sign. Is the company actually profitable? Is its net income, the money left over after all the bills are paid, positive and growing? And critically, how much debt does it have? A company with a mountain of debt is like a swimmer with an anchor tied to their ankle. It can be a huge risk, especially if the economy takes a downturn. And finally, the fourth and most difficult piece of the puzzle: valuation. A wonderful company can be a terrible investment if you pay too much for it. This is the single biggest mistake new investors make. They find a great company, but they buy it after the price has already shot to the moon. Buffett has another great saying for this: price is what you pay, value is what you get. You can buy a fantastic brand new car, but if you pay $500,000 for a Honda Civic, you've made a terrible investment. Your job as an investor is to try and figure out what a company is truly worth, its intrinsic value, and then wait for an opportunity to buy it for less than that. This is called having a margin of safety. This is where metrics like the price-to-earnings or PE ratio come into play, but the concept is simple. You're looking for a sale. You want to buy that incredible business when it's temporarily out of favor, when the market is pessimistic, when the price is fair, or even better, cheap. So you have 2 clear choices. Path 1. Buy the entire supermarket with an index fund. It's simple, diversified, and has a proven track record of success. Path 2. Become a business analyst. Find individual companies you understand that have a protective moat, strong financials, and are selling at an attractive price. Neither path is inherently right or wrong. In fact, many successful investors do both. They build the core of their portfolio with broad market index funds, and then use a smaller separate portion of their money to take shots on individual companies they believe in. The crucial step is to consciously choose your strategy instead of just randomly buying what's popular. Making that choice gives you a framework, a plan of attack. It moves you from a gambler to a strategist. And once you have that strategy in place for what to buy, the next two questions hit you like a 1-2 punch. How much money do I actually need to get started, and is now a good time to invest? Let's tackle that first question head on. How much money do you actually need? For decades, the answer felt impenetrable, like a secret whispered only in country clubs and on Wall Street trading floors. The perception was that you needed thousands, maybe tens of thousands of dollars just to get a seat at the table. If you didn't have a huge lump sum to hand over to a broker in a suit, you were out of luck. That perception, that high barrier to entry, has kept generations of people on the sidelines, convinced that investing was a game played only by the wealthy. But I'm here to tell you that wall has been completely demolished. The single biggest technological revolution in personal finance over the last decade wasn't crypto or some complex algorithm. It was the simple, beautiful concept of the fractional share. Think about it like this. Let's say you want to own a piece of a fantastic, world-changing company, but its stock price is over $1,000 per share. In the old days, you were stuck. You had to save up that full $1,000 to buy just one single share. It was like wanting a slice of the best pizza in town, but the restaurant would only sell you the entire extra-large pie. Most of us would just walk away hungry. Fractional shares changed the menu. Now you can walk up to that same pizza place and say, "I'll take $1 worth of your pizza," and they'll slice off a tiny sliver for you. It's still the exact same pizza, made with the exact same ingredients, from the exact same world-class chef. You just own a smaller piece of it. That's all a fractional share is. You can go to your brokerage app and say, "I want to buy $5 worth of Amazon," or "I want $10 worth of Apple," and you will become a part owner of those companies instantly. This innovation does more than just lower the price of admission. It fundamentally changes the goal for a beginner. Your goal is not to invest a huge, scary amount of money on day one. Your goal is to build the habit of investing. It's a psychological shift. Getting started with $5 or $20 isn't about the return you'll make on that specific $20. It's about proving to yourself that you can do it. It's about building the muscle memory of setting money aside, moving it into an investment account, and putting it to work. Think of it like starting a fitness journey. You don't walk into a gym for the first time ever and try to deadlift 500 pounds. You'd hurt yourself and you'd never come back. Instead, you start with the lightest weights. You focus on your form. You learn the movements. You build a routine. You show up consistently even on days you don't feel like it. The person who goes to the gym and lifts light weights 3 times a week, every week, will be in far better shape a year from now than the person who tries to lift a heroic amount of weight once, gets discouraged, and quits. Investing is the exact same. Consistency will always beat a large one-time amount. The habit is infinitely more valuable than the initial sum. So, how much money do you need to get started? You need $1. You need $5. The real answer is, you need an amount so small that you won't even notice it's gone. An amount that doesn't cause you any stress or anxiety. Start there, because once you prove to yourself that you can start, you've overcome the single biggest obstacle. And that leads us directly to the second and arguably more terrifying question. Is now a good time to invest? This is the question that paralyzes millions. You turn on the news and it feels like the world is constantly on the brink of collapse. Pundits are screaming about a coming crash. The market just hit an all-time high, so it must be about to fall, right? Or maybe the market just crashed, so it must be about to fall even further, right? There is always a perfectly logical, intelligent-sounding reason to be terrified of investing your money today. Fear is the mind killer, and when it comes to the stock market, it is the portfolio killer. This fear is rooted in a desire we all have. We want to be perfect. We want to time the market. We have this fantasy of swooping in and investing all of our money at the absolute bottom, right before the market skyrockets, and then pulling it all out at the absolute peak right before it crashes. We'd be geniuses. We'd be rich. The problem? It's a complete fantasy. It's impossible. Let me be clear. Not just for you, but for everyone. The most brilliant minds on Wall Street, with their supercomputers and PhDs in astrophysics, cannot consistently time the market. And they have the data to prove it. The legendary investor Peter Lynch famously said, Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. People sit on the sidelines in cash, waiting for that perfect moment to jump in. They wait and wait and wait as the market climbs without them. They miss out on all the gains because they're so afraid of a potential loss. The solution is to replace one phrase in your mind with another. Stop thinking about *timing the market. Start thinking about *time and the market. It's not about when you start, it's about how long you stay. And the strategy that enables this is called dollar cost averaging. It sounds complicated, but it's incredibly simple. It just means investing a fixed amount of money on a regular schedule, no matter what the stock market is doing. $20 every Friday, $100 on the first of every month. The amount and the schedule don't matter as much as the consistency. Think of it like buying gasoline for your car. You don't try to time the global oil markets. You don't empty your bank account to fill 50 gas cans when the price drops by a nickel. You just fill up your tank when it's getting low, maybe once a week. Some weeks you pay a little more. Some weeks you pay a little less. But over the course of a year, you end up paying an average price. You've dollar cost averaged your gasoline purchases without even thinking about it. That's exactly what you do with your investments. When you invest the same amount every month, sometimes you'll be buying when the market is high. You'll get fewer shares for your money. But other times you'll be buying when the market is low, when everyone else is panicking and selling. During these sales, your fixed dollar amount buys you more shares. Over time, this smooths out your purchase price and, more importantly, it removes the emotion and guesswork from the equation. You're no longer trying to be a psychic. You're just executing a plan. Let me tell you a story to illustrate just how powerful this is. Imagine the unluckiest investor in history. Let's call him Bad Luck Bob. Bob only invested in the stock market 4 times in his entire life. He saved up a big chunk of money, and with the absolute worst timing imaginable, he invested it all at the peak of the market right before a major crash. He invested in late 1972, right before a 48% crash. He invested in August of 1987, 2 months before the infamous Black Monday crash. He invested in December 1999, at the absolute peak of the dot-com bubble, right before it burst. And his last investment was in October of 2007, the market peak right before the great financial crisis. Every single time, he invested at the worst possible moment. His timing was a catastrophe. And yet, if he had just left that money in a simple S&P 500 index fund and never touched it, by today, he'd still be a multimillionaire. Even the unluckiest market timer in the world wins, as long as he has enough time in the market. Now imagine another investor, consistent Claire. She didn't have big lump sums of money like Bob. She just invested $100 every single month, starting at the same time as Bob. She never paid attention to the news. She never worried about all-time highs or scary headlines. She just invested her $100 on the first of the month every month. When the market crashed, her $100 bought more shares. When the market soared, her $100 bought fewer shares. She just kept going. Over that same period, Claire, with her simple, boring, automated strategy, would end up with significantly more money than Bad Luck Bob. She didn't have to be a genius. She didn't have to be lucky. She just had to be consistent. So is now a good time to invest? The data is overwhelmingly clear. The best time to start was 20 years ago. The second best time is right now. Not tomorrow, not next week, not after the next inevitable crash. Now, with a small amount you won't miss. With a plan to invest that same small amount on a regular schedule forever. That is how you turn fear into a strategy, and a strategy into wealth. That strategy, that plan, immediately crashes into the next great wall of fear. What on earth do I actually buy? This is our fourth question, and for many, it's the most paralyzing one of all. You've conquered the fear of when to start, only to be confronted with the terrifying reality of what to choose. Imagine walking into the world's largest supermarket. It's called the U.S. stock market. Inside, there are over 6,000 different aisles, each representing a publicly traded company. Down one aisle you have Apple. Down another, Ford. Over there is Pfizer, and way in the back, a tiny startup you've never heard of that just went public last week. The sheer volume of choice is overwhelming. The financial news channels are like frantic shoppers screaming at you. Buy the avocados. They're hot today. While a podcast host whispers in your ear, no, the real secret is this organic artisanal kale stock in aisle 4328. You stand there frozen holding your shopping cart, terrified of putting the wrong thing in it. So you do nothing. You walk out empty-handed week after week, while others are building pantries full of wealth. This paralysis is by design. The world of finance has an interest in making you believe that investing is a complex game of picking winners and losers, a game that only the experts with their secret formulas and expensive terminals can win. They want you to think you need to be a genius stock picker, a modern-day treasure hunter searching for the next Amazon buried in a mountain of financial reports. This is the Hollywood version of investing. It's exciting, it's dramatic, and for 99% of people it's a direct path to failure. Let's be honest. The dream is seductive. We all hear the stories of someone who bought Tesla stock for $17 in 2010 and is now a multimillionaire. We fantasize about finding that one company, that one revolutionary idea, that will turn $1,000 into $1 million. And because of that fantasy, people spend countless hours trying to do the impossible, consistently predict the future. They read charts like tea leaves, they listen to so-called gurus, they bet their savings on a hunch or a hot tip. But for every Tesla, there is a graveyard of forgotten companies. Remember Blockbuster? It was a blue-chip, can't-miss stock. Until it wasn't. Remember Enron? One of the biggest companies in America. Until it was a fraud. For every person who got lucky picking a winner, there are thousands who lost their shirts betting on a company that went to zero. Trying to pick individual stocks isn't just investing. It's a second job. And it's a job you're competing against hundreds of thousands of the smartest, most well-funded people on the planet who do it for 80 hours a week with technology you can't even imagine. To believe you can beat them at their own game by reading a few articles online is the height of hubris. Even the professionals can't do it. Study after study has shown that over any 10 to 15-year period, more than 85% of professional, full-time fund managers fail to beat the market's average return. These are the supposed experts and they can't do it. What makes us think we can? So if picking individual stocks is a loser's game, what's the alternative? What if, instead of trying to find the one perfect item in that giant supermarket, you could just buy the whole store? This is the single most powerful and important concept for the average investor to understand. It's the key that unlocks the entire market. It's called index fund investing. An index is just a list, a shopping list. The most famous one is the S&P 500. The Standard & Poor's 500 is simply a list of 500 of the largest, most profitable, and most influential publicly traded companies in the United States. It includes names you know and use every day: Apple, Microsoft, Amazon, Google, Johnson & Johnson, Visa, Walmart. When you hear on the news that the market is up today, they are usually talking about the S&P 500. It's the benchmark for the entire U.S. economy. An S&P 500 index fund is a single investment vehicle like a mutual fund or an ETF that automatically buys you a tiny piece of all 500 of those companies in that exact proportion. With one click, for just a few dollars, you can own a sliver of the entire American corporate engine. You're not betting on one company. You're not betting on one CEO or one new product. You are betting on the long-term growth, innovation, and resilience of the American economy as a whole. When you buy an S&P 500 index fund, you instantly own a piece of the iPhone in your pocket, the software on your computer, the package that arrives at your door, the credit card you swipe, and the store where you buy your groceries. Some of those companies will have a great year. Some will have a terrible year. Some might even go out of business. But it doesn't matter, because the index is self-cleansing. When a company shrinks and fails, it gets kicked out of the index and replaced by the next rising star. You, as the owner of the index fund, don't have to do a thing. The winning companies automatically grow to become a bigger part of your portfolio, and the losers shrink into irrelevance. You are permanently positioned to own the winners, whoever they may be. It's like owning a sports team where your worst players are automatically replaced by the best rookies. Every single season, forever. Why would you ever bet on a single player when you can bet on the whole league, guaranteed to have all the all-stars? This isn't some fringe theory. This is the gospel preached by the most successful investor in human history, Warren Buffett. For decades, Buffett has advised that the best thing most people can do is to consistently buy and hold a low-cost S&P 500 index fund. In his 2013 letter to his shareholders, he revealed that his will instructs the trustee of his wife's inheritance to put 90% of it in a very low-cost S&P 500 index fund. Think about that. The greatest stock picker of all time, the man who built a $100 billion fortune by analyzing and selecting individual companies, tells his own family not to do what he did. He tells them to buy the index. He even put his money where his mouth is. In 2007, he made $1 million bet against the hedge fund industry. He wagered that a simple unmanaged S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years. The hedge fund experts with their PhDs and supercomputers scoffed. They thought it was easy money. 10 years later, Buffett won the bet, and it wasn't even close. The simple index fund had crushed the performance of the so-called smart money. The lesson is profound. The single best way to win the game is to stop playing it. Buy the whole market. Buy the haystack instead of searching for the needle. Now, I can hear the objection. But isn't that boring? Yes, it is. And in investing, boring is beautiful. Boring is profitable. Boring is what builds wealth while you sleep. The goal of investing isn't to give you a shot of adrenaline. It's to fund your real life. The excitement should come from traveling, from spending time with your family, from quitting the job you hate. All things made possible by your wonderfully boring, relentlessly compounding investments. Let the market do the hard work so you can live your life. So how do you do it? You buy these index funds through vehicles called ETFs, exchange-traded funds, or mutual funds. You can buy them in any standard brokerage account. You've probably heard their ticker symbols, which are like the stock's nickname. Tickers like VOO, IVV, or SPY are all massive, popular, and very low-cost ETFs that track the S&P 500. And it's not just the S&P 500. You can buy index funds that track the total US stock market or the total world stock market, giving you even more diversification. The answer to the terrifying question of what do I buy is, for most of us, beautifully simple. You buy everything. You stop trying to be a hero, you stop trying to find the lottery ticket, and you align your personal wealth with the greatest wealth-generating engine the world has ever known: the broad U.S. economy. You place one simple, powerful bet that the future will be better than the past, and you let the 500 best-run companies in the country work day and night to prove you right. And this leads us to the single biggest question that paralyzes more potential investors than any other. It's the ghost in the machine, the monster under the bed of personal finance. You're convinced. You understand the power. You're ready to bet on the future. But when? When is the right time to buy? Do you wait for the market to dip? Do you jump in now while it's hitting all-time highs, terrified it's about to crash? This question of timing, of trying to perfectly nail the bottom and sell at the top, is the siren song that has lured countless financial ships to their doom. Because here is the brutal, liberating truth. You can't time the market. Nobody can. Not the hedge fund wizards on Wall Street, not the talking heads on TV, and certainly not you or me. Trying to do so is a fool's errand. It's not investing, it's speculating. It's turning a winning game played over decades into a losing game played over minutes. To prove this to you, let me tell you a story. It's the story of Bob. Bob is, without a doubt, the world's worst market timer. His luck is so spectacularly bad it borders on a superpower. Let's imagine Bob started his investment journey back in 1987. He saves up $60,000, a huge sum of money, and he decides to go all in on the S&P 500. The date he chooses to invest every last penny? August 25, 1987. The absolute peak of the market right before one of the most infamous crashes in history, Black Monday. In a matter of weeks, Bob's $60,000 is decimated. He loses over a third of his investment. His friends who kept their money in cash are laughing at him. He feels like a complete and utter fool. But Bob, for all his terrible timing, does one thing right. He doesn't sell. He grits his teeth, closes his eyes, and holds on for dear life. A decade goes by. The market recovers and then some. Bob, having learned his lesson about going all in at once, starts saving again. He diligently puts away money for years, watching the tech boom of the late 90s create millionaires overnight. He saves up another $60,000, determined not to miss out this time. He sees the frenzy, the excitement, and he finally pulls the trigger. The date he invests his second lump sum? December 1999, the absolute tippy-top of the dot-com bubble. What happens next is a slow, agonizing bleed. The bubble bursts. The market crashes, not in a single day but over 2 long, painful years. Bob's portfolio is once again a sea of red. His tech-savvy neighbors who cashed out are buying new cars. Bob feels like the universe is personally conspiring against him. But again, what does he do? He holds. He doesn't panic sell. He just holds. Another several years pass. The market claws its way back. Bob, now a seasoned veteran of catastrophic market timing, has managed to scrape together another $60,000. He's much more cautious this time. He sees the housing market is booming, things are looking good. He waits. He watches. He finally decides the coast is clear and it's time to invest his third and final lump sum. The date? October 2007. The absolute peak of the market right before the global financial crisis. The most devastating economic collapse since the Great Depression. The entire global financial system comes to the brink of implosion. The market doesn't just fall. It plummets into a black hole. Bob's portfolio is annihilated. It's a bloodbath. This time he's lost more than half his money. Seems like it's all over. His dream of a comfortable retirement is a smoldering ruin. It would be so easy, so human to just give up. To sell everything, take what little is left, and vow to never touch the stock market again. But Bob, the unluckiest investor in history, does the one smart thing he knows how to do. He holds on. Now let's fast forward to today. After 3 of the worst-timed investments in the history of the world, what do you think happened to Bob's money? He's ruined, right? Living on Social Security and canned beans? Not even close. Despite his epically bad luck, despite buying at the absolute worst possible moments, Bob's initial $180,000 would have grown to over $2 million. Let me repeat that. The world's worst market timer, a man with a gift for buying at the peak right before a crash, became a multimillionaire. Why? Because he understood the single most important rule of investing. It's not about timing the market, it's about time in the market. The engine of American capitalism is so powerful, so relentlessly innovative, that over the long run, it overcomes wars, pandemics, bubbles, and crashes. Bob's story proves that the real risk isn't being in the market during a downturn. The real risk is not being in the market at all. So if trying to find the perfect time is a fool's game, what's the alternative? The answer is one of the most powerful and beautifully simple strategies in all of finance. Dollar cost averaging. Sounds complicated, but it's not. All it means is that you invest a fixed amount of money on a regular schedule, no matter what the market is doing. Every week, every 2 weeks, every month, like clockwork. You pick an amount, say $500 a month, and you automate it. That money goes into your S&P 500 index fund on the same day every month, whether the market is soaring, crashing, or going sideways. This strategy is a superpower for 2 reasons. First, it completely removes emotion from the equation. You're no longer staring at charts trying to guess the future. You're not stressing about whether now is a good or bad time to buy. The decision is already made. You've turned investing from a series of terrifying, high-stakes decisions into a boring automatic habit, like paying your electric bill. This psychological freedom is priceless. But the second reason is where the real magic happens. It's mathematical. Think about it. When the market is high and stocks are expensive, your $500 buys you fewer shares. But when the market inevitably dips, when fear is in the air and prices are falling, your $500 suddenly has more buying power. It buys you more shares than it did the month before. When the market crashes and everyone else is panicking and selling, your automatic system is calmly, unemotionally, buying up shares at a massive discount. Dollar cost averaging fundamentally changes your relationship with market downturns. A market crash is no longer a catastrophe to be feared. It's a sale. It's a Black Friday event for stocks, and you're the disciplined buyer, scooping up quality assets for cheap while others are running for the exits. Over time, this strategy lowers your average cost per share and can significantly boost your long-term returns. Every single crash in the history of the U.S. stock market, 1929, 1987, 2000, 2008, 2020, has one thing in common. They all ended. And every single one was eventually followed by a new record-breaking all-time high. The market takes the escalator up and the elevator down. The drops are fast and terrifying, but the long-term trajectory has always been up and to the right. By investing consistently through thick and thin, you ensure that you are present for the inevitable recovery and the powerful growth that follows. You're not trying to be a hero swooping in at the perfect moment. You're just being consistent. And in the world of investing, consistency beats heroism every single time. So the answer to the question, when should I invest, is beautifully simple. Start now, and then continue automatically and consistently forever. Start with whatever you can afford, whether it's $50 or $5,000, and let the dual engines of time and dollar cost averaging do the heavy lifting for you. This approach tames the market's volatility and turns its biggest perceived weakness into your greatest strength. Now, we've covered what the market is, why it's not gambling, how to start with a simple index fund, and when the best time to invest is. This covers the strategy. But there's one final crucial piece of the puzzle we need to address. It's the part most people ignore until it's too late, the silent partner in all your gains, the tax man. Because it's not just about how much money you make, it's about how much money you keep. How do you structure all of this in the most efficient way possible? What are these accounts people talk about, like a 401k or a Roth IRA? And why are they considered the closest thing to a legal cheat code for building wealth? Let's break down that cheat code. Imagine you're playing a video game. You could play on the normal difficulty, fighting every enemy, grinding for every single coin. Or you could enter a secret code that gives you a power-up, making the entire game easier, faster, and more rewarding. That's exactly what these retirement accounts are. They are a power-up for your money, legally sanctioned by the government to encourage you to save for your future. The enemy in this game is taxes. Every time your investments make money, when you sell a stock for a profit or receive a dividend, Uncle Sam wants a piece of the action. This is called capital gains tax. Over decades, this tax drag can feel like you're trying to run a marathon with a parachute strapped to your back. It slows you down, siphoning off a significant portion of your potential wealth. But these special accounts are like a force field against that tax drag. They come in two main flavors, the 401k and the Roth IRA. Let's start with the 401k, the one you get through your job. Its superpower is tax deferral. This sounds complex, but it's beautifully simple. When you contribute to a 401k, the money comes directly out of your paycheck before federal and state income taxes are calculated. Let's make that real. Say you earn $1,000 on your paycheck. If you contribute $100 to your 401k, the government only sees you as having earned $900. You get taxed on the smaller amount. It's like you're wearing an invisibility cloak that hides some of your income from the taxman. That $100 goes straight into your investment account, untaxed, to start growing and compounding immediately. You'll eventually pay taxes on this money, but not until you retire decades from now, when you're likely in a lower tax bracket anyway. But that's not even the best part. The true magic of the 401k is the employer match. This is the closest thing to free money that exists on planet Earth. Many companies will say, for every dollar you put in, up to a certain percentage of your salary, we'll put $1 in too. Or maybe they'll match 50 cents for every dollar. Whatever the formula, it is a 100% or 50% guaranteed instantaneous return on your investment. There is no stock, no bond, no piece of real estate that can promise you that. Not contributing enough to get your full employer matches, without exaggeration, like taking cash out of your wallet and setting it on fire. It is the single biggest financial mistake a young professional can make. Before you do anything else, before you even think about other investments, you must contribute enough to your 401k to get every last penny of that free match. It's a non-negotiable first step on the path to wealth. So the 401k is your workplace powerhouse. But what if you're self-employed? Or what if you want to do more? That's where the second hero of our story comes in, the Roth IRA. An IRA, or individual retirement arrangement, is an account you open yourself at a brokerage like Fidelity, Vanguard, or Charles Schwab. It's not tied to your employer. And the Roth version is, in many ways, the mirror image of the 401k. With a 401k, you get your tax break now. With a Roth IRA, you pay your taxes now. The money you contribute to a Roth has already been taxed, just like the money you use to buy groceries. But here is the life-changing part. Once that money is inside the Roth IRA, it grows completely 100% tax-free. Forever. All the dividends, all the capital gains, all the compounding for 10, 20, 40 years, it's all yours. When you reach retirement age and pull that money out, you owe the government nothing. Zero. Zilch. Nada. Let's paint a picture. Imagine you're 25. You diligently contribute to a Roth IRA for 40 years. Thanks to the power of compounding and the growth of the stock market, that account is now worth $1 million. When you go to take that money out to live your dream retirement, the government can't touch a single cent of it. A $1 million withdrawal means $1 million in your pocket. Now compare that to a regular taxable brokerage account. That same $1 million nest egg could easily come with a six-figure tax bill. The Roth IRA is a promise. Pay your taxes on the small seed today, and you get to keep all of the massive harvest tomorrow completely tax-free. It is a profoundly powerful wealth-building tool. So this leads to the inevitable question. Which one is better? The 401k with its immediate tax break, or the Roth IRA with its tax-free future? The classic advice depends on one simple question. Do you think your tax rate will be higher now, or in retirement? If you're a young professional just starting your career, Your income is likely the lowest it will ever be. Your tax rate is low. In this case, it makes sense to pay those low taxes now with a Roth IRA, so you can enjoy tax-free withdrawals later when you're in a higher tax bracket. If you're in your peak earning years with a high income and a high tax rate, then the immediate tax deduction from a 401k becomes much more attractive. But the real world-class answer isn't one or the other. It's a strategic order of operations. Step 1. Contribute to your 401k up to the full employer match. Always. This is free money. It's the foundation. Step 2. After you've secured the match, shift your focus to a Roth IRA. Contribute as much as you can, up to the annual limit set by the IRS. Step 3. If you've maxed out your Roth IRA for the year and still have money you want to invest for retirement, go back to your 401k and contribute more there, up to its own much higher annual limit. By following this simple 3-step process, you get the best of both worlds. You secure the guaranteed return of the match, and you build a bucket of tax-free money for retirement, all while systematically building your future. And that's the final piece of the puzzle. We've journeyed through the 5 most common questions that hold people back, and we've dismantled them, one by one. Is the stock market just gambling? No. It's owning a piece of the greatest wealth creation engine in human history. Do you need to be a Wall Street genius to succeed? Absolutely not. By simply owning a low-cost index fund like an S&P 500 fund, you can outperform the majority of professionals over the long run, just by participating in the market's overall growth. When is the right time to buy or sell? The answer is to stop trying to time the market. The secret isn't timing the market, it's time in the market. Consistent, automatic investing through the highs and the lows is the proven path. How much money do you need to start? You don't need a fortune. You need a habit. Starting with just $50 or $100 a month can grow into a life-changing sum over time, thanks to the magic of compound growth. And finally, how do you do it all in the most efficient way? You use the legal cheat codes. You use tax-advantaged accounts like a 401k and a Roth IRA to protect your money from taxes and supercharge its growth. This isn't just about numbers on a screen. This is about reclaiming your time. It's about having the freedom to choose your work, not because you have to, but because you want to. It's about having the resources to handle any emergency life throws at you without panic. It's about building a legacy, changing your family's financial future, and designing the life you truly want to live. The stock market can seem intimidating from the outside, a private club with complex rules and a secret handshake. But it's not. It's a tool. And now you understand how to use it. The path is simple, it is proven, and it is available to every single one of us. The only question left is, will you walk it?